Visa is still the most obvious buy in the stock market, and in today's episode we're going to run through exactly why that is. We're going to look at the historical performance of the company. We're going to run through their top line growth, their bottom line net income growth as well, based on their latest earnings. We're going to take a look at their total cash versus total debt to get a good sense of the health of this company. We'll also see how they've performed versus some of their competitors in the industry, and we'll see what does this insider buying and selling really mean for the company. As always, we'll look at their dividend safety, look at their financial metrics, and we'll take a peek and see what are the institutions doing, are they buying or selling, and we'll highlight a few things from their latest Q4 2023 presentation. And as always, we will run them through our valuation model, getting to our intrinsic value and our acceptable buy, given that investor margin of safety, and see what Wall Street are forecasting for Visa over the next 12 months. Now, Visa is a company that I keep saying that is an obvious buy. It is one that through the last few months has gained a lot of traction. The share price is up significantly, and in my opinion, it continues to be one of the best buys in the market. So over the last year, it is up 23%. We can see over the last 10 years, up nearly 400%, and that doesn't include those dividends reinvested. It is at its 52-week highs, but as always, that is not an overvaluation signal and does offer a yield of just under 0.8% with a forward P of just over 27. So in terms of their income statement, as always, on the top line, we like to see 3 to 7% growth year on year. And what we can see, 2019, 23 billion, 2023, 33 billion. So we can see their top line has in fact nearly increased by 50% over the last 5 years. Yes, we do see a dip in that COVID year, but it did then rebound very nicely, and we can see that continued growth. In terms of their bottom line net income, it has gone from around 12 billion to around 17.3. So again, not only nearly 50% increase to the top line, but also the bottom line. And again, we do notice that COVID drop before rebounding for continual growth. So both top line and bottom line have increased over the last 5 years, other than that COVID drop that we saw. In terms of the health check, well, 12 billion of cash and short-term investments in 2019. Latest quarterly report showing 20 billion. So we can see they are holding on a lot more cash than they did 5 years ago. In terms of their total debt, then numerically and directionally, we can see it has gone from around 17 billion in 2019 to around 21 billion from their latest report. So yes, their cash has increased, but to the same effect, so has their total debt. And we'll take a very quick look at their net debt to EBITDA metric shortly as well. Now, in terms of other companies in the industry, we have MasterCard, we have PayPal, and a few others. To be honest, if I was to compare, MasterCard would be the only like-for-like real comparison, but we can take a look at some of the others. On a total return basis, well, Visa over the last year is up 24%, the second best. As we can see here, Pfizer up 36%. They have outperformed MasterCard over the last 5 years. And when we expand that over the last year, that was, Visa has outperformed MasterCard. But when we expand that over the last 5 years, we see the opposite. MasterCard is the best performing and has outperformed Visa on a total return basis. Now, always do remember, past performance is never an indicator for future, but it is always good to add in our reviews. Now, in terms of Visa, we have filtered them through this essential insider buying and selling with at least 100 shares over the last 3 months. And what we've noticed in November and December of last year, a lot of selling by chairmen, CEOs, and the president of the technology department. Just a few things to point out here. Now, typically, insider buying is very bullish. When we see any insiders buy, it is really only for one reason, and that is because they do believe the share price of the company will increase over the next 12 months and beyond. Insiders sell for many reasons, and this is such as personal reasons, they need the money, financial reasons. And one thing to point out here, we can see every single one of these sales have been below the current trading price, which is around $270. Nonetheless, it is just worth noting and discussing. Institutional ownership, well, it sits at 81%, as we can see here. 40 billion worth of outflows over the last 12 months, with a significant more of inflows over the same period. And we can see that significant period in Q2. In the latest period, Q4, we see slightly more inflows than outflows. Now, just one thing just to point out when we do take a look at this fiscal fourth quarter presentation deck, what I wanted to highlight here was their performance, as we can see here, versus Q4 versus last year's. Now, their revenues, both on a GAAP basis and on a non-GAAP, as we can see here, is up 11%, and on a non-GAAP is also up both on the net income 19% and also the earnings per share 22%. So the real thing I did just want to highlight from this slide deck here is that their revenue top line, bottom line, as well as earnings per share, not only has it increased, which should come as no surprise, but we're talking about double-digit increases to every single metric. On top of that, their year-on-year increases to some of their KPIs, their payment volumes up 9%, their volumes excluding intra-Europe up double digits, as well as their processed transactions. So really what I wanted to point out here, this isn't a company that is slowing in their growth. We're continually seeing double-digit increases to some of their KPIs, as well as some of their financial metrics, their top line, bottom line, and earnings per share. Now, we can see this when we look at the essential financial metrics, but straight away, dividend safety score, the highest score obtainable of 99. It is very safe. Market cap, 545 billion, a mega cap company. Key metrics then, well, they increased the dividend during the last recession, and we can see plus 10% sales, which was above the average growth, which was around negative 12%. On top of that, what we love here as dividend growth investors is that double-digit increase to the dividend, 16% October last year, 16% last 5 years on average, 18% over the last 10 years. Now, when we take a look, they have also been increasing those dividends for the last 15 years. Dividend yield theory now, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 0.77 versus 0.67. And another sign here, double sign in fact, 27.4 below the 5-year average of 29.2. Bear in mind though, we're not looking at any of these in isolation. Sector P though, no surprise, Visa, for the premium quality of a company it is significantly higher than the financials of 11. Now, in terms of the free cash flow, remember we ignore earnings. It is susceptible to manipulation by management through accounting. We focus on the free cash flow. Now, below 60% is what we target. Gives us faith management are able to offer those double-digit increases. In fact, it's been below 20% nearly every single year. 2023, the latest year at 19%. I would be shocked if we do not see another strong double-digit dividend increase for Visa shareholders. Free cash flow per share, well, 266 in 2014. 962 in 2023. We can see more than 3 times the growth, and whilst it isn't consistent increases, it is moving in the right direction. Sales growth, well, nearly double-digit increases every single year, no surprise there, and we do see that justified 5% COVID drop for Visa's top line. Numerically then, it is nearly 3 times growth over the period, 12.7 billion to 33. Shares outstanding, more beautiful metrics here, 2.52 billion shares outstanding, down to 2.09 in 2023. So they are returning a lot of excess cash to shareholders over the period. ROIC, remember, for me personally, I avoid any company that doesn't have a minimum of 10% ROIC. The reason for this, it gives me faith that the management team are able to effectively allocate their capital. 2023, 34%, very, very strong. Operating margin, free cash flow margin, probably one of the best metrics you will ever see for a company. 67% nearly continuously over the last 10 years. Free cash flow margin, over the last 3 years, low 60s, absolutely phenomenal. Visa is a free cash flow machine. On top of that, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us 2 things, the dividend safety as well as the balance sheet strength. Should come as no surprise, this is showing 0.05, meaning it wouldn't even take them 0.05 years to pay off all of their debt net of cash on hand. So this is a very strong company. The balance sheet is looking very positive, and that dividend is safe, and again, it should come as no real surprise. So let's jump into the valuation model, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, before we just jump into the valuation model, we are having a free weekly newsletter. The first one is dropping tomorrow, where we will be discussing the 7 golden dividend metrics we look for when analyzing companies, what exactly we're looking for, the numbers, a lot of information if you want to see how we get to the stocks we look at. So do click on that pinned comment below to sign up to the free weekly newsletter. So jumping into the valuation model, we can start off with the first model, which is Graham's valuation. However, for today's episode for Visa, the reason being we're not going to use this is because they are growing their top line at a very rapid double-digit rate. Therefore, Graham's valuation isn't appropriate. So the first model we're using is the multiples. Now, we only really have MasterCard, in my opinion, that we can compare it to. So based on MasterCard, we're getting an intrinsic value for Visa at around $314.65. So we have our first sign of undervaluation. Bear in mind, though, we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end. Yearly dividends we have for Visa, we have the average growth rate of 16%. Forward looking, we've gone 7.25. Again, depending on your pessimistic or optimistic, you can have different numbers. We can see here undervaluation as that intrinsic value sits above the market value. Third and final, probably my favorite model, the DCF discounted cash flow model. We have the free cash flows year on year. Average growth rate. Forward looking, we've gone for lower than what analysts believe to be more conservative. In conjunction with the discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have that intrinsic value again, third and final sign of undervaluation. As always, if you do want to grab a copy of this model, do click on that pinned comment below where you can grab a copy to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list. Margin of safety, as always, we do start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, this is probably one of the rare times that I would say a company can be suitable for a 10% margin of safety, and it isn't too far off the current trading price. Now, I know a lot of people will be saying that this is currently at a 52-week high. It's overvalued. They'll be waiting for a drop. Now, who's to say a drop will come? It may not come. My personal strategy is dollar cost averaging in, and we have run through the metrics for Visa. It is looking very strong. I could run off all the metrics. They are absolutely incredible. Now, in terms of looking when to buy, again, dollar cost averaging, we have gone through Visa many times on the channel. If you do want to check, every single time I say the same thing. It is an obvious buy in my opinion, and the share price has been increasing a ton since the videos we have essentially reviewed. So what does that tell you? It is a premium company. It rarely trades at a dip. It rarely dips significantly. But again, everyone has their own investing strategy, so I would be inclined to hear what you think. In terms of Wall Street, well, they do see upside of around 8% with a price target of $293. As always, have a great day. Don't forget to sign up to the free newsletter. It will be dropping tomorrow, so do not miss out. And as always, catch you on the next episode and take care.